part of our ongoing education series on the primary and secondary structured settlement market, I've got a special guest today. My guest is Trish Laborde, who is the Senior Vice President and Division Counsel of Stone Street Capital and the President-elect of the National Association of Settlement Purchasers. Hello, Trish. How are you doing today?
Great.
Excellent. Well, I understand that you're doing a interesting presentation at the upcoming annual meeting of the National Association of Settlement Purchasers on life contingent structured settlement payments and the difficulties and problems with pricing out those types of cash flows when people are trying to sell them. Could you elaborate a little bit for our listeners?
Sure. Well, to understand our issues with life contingent transactions, you have to understand that every structured settlement purchasing company borrows money in order to fund our structured settlement transactions. We go to a bank or some other institutional investor or some other source of financing to come up with the funds. And generally, what happens, that floor, that cost of funds, is the floor for the rates at which we assess our transactions. For example, if we borrow money at 6%, we obviously can't purchase a structured settlement payments for lower than 6%. Because we would lose money on every transaction. In life contingent transactions, since we will not get the payments upon the death of the annuitant, they are riskier for both us and our investor, and we have to do something to kind of hedge against that risk.
Does that risk mean that you go out and buy a life insurance policy?
Well, there's two ways to do it. You either go out and you buy a life insurance policy, and you can, if you ever looked at a structured settlement transaction, those are pretty clear. On the disclosure statement, there'll actually be a deduction in the expense section for a life insurance policy. For reasons not related to our industry, it's getting tougher to find insurance companies willing to sell life insurance under these circumstances. So the other option is to not hedge against the risk of death, and to just, ascribe some kind of value to the additional risk that you undertake by buying life contingent transactions. And the way you ascribe a risk is the rates go up. So what you'll see in those transactions is that the rate for a 20-year-old healthy individual selling structured settlement payments is going to be lower than the rate assessed to a 60-year-old smoker who's had a heart attack in the past. Because that rate that we are borrowing money, that we're trying to kind of capture that risk, is assessed in the rate assessed to the individual annuitant.
Trish, how do factoring companies assess the mortality risk? Do they go out and hire their own medical underwriters or hire actuaries? What type of process do they go through, just in general terms?
Yeah, we actually work with actuaries who determine who look at the pool that we've of transactions that we've kind of pulled together. They look at an individual and they do underwrite them. They look at their medical history, their criminal history, which actually plays into your risk. They look at what kind of prescription drugs you're on, your age, various factors to come up with